All right, everybody, in today's YouTube video, I'm going to talk about put credit spreads. Before I go any further as to what they are and how they work, if you're getting value out of my content, there are 4 simple things I want you to do. Like this video, subscribe to the channel, share it with your friends, and then hit the alert so you get alerted whenever new videos come out. So with put credit spreads, they are great when you are bullish on a stock. And they're also really good in a high volatility environment. A lot of times people will express the level of stock market volatility. They'll use the VIX index, the VIX, and generally the higher that number, the higher the premium will be for options. And this will also become a bigger and bigger benefit to you. So what you're doing, it's a 2 option trade. You will be selling a put at a higher strike price and you will buy a put at a lower strike price. What you are doing there is you're creating a spread where your max profit will be the net premium you get. And we'll do an example. I think it'll make a little bit more sense. Like we'll see a stock like Apple and we'll walk through it. But that is essentially what you are doing. Now to do this, you will need a margin account. You don't have to use the margin, but you will need one. You will also need clearance from your broker to be able to trade spreads, which is usually like a level 2. But you can look, it depends on what your broker is, but you will have to get that level to be able to do spreads. So let's use an example, because I think an example makes the best way. So let's take a stock like Apple, and the price right now, as of July, we're gonna say it's 155. We're gonna say it's 155, and it's run up a little bit, but you're confident. You think, hey, I think they're gonna do well in earnings. I think it's going to stay above. We'll say I think it could easily stay above 140. And so what you do is you say, I think it's going to stay above 140, but I also, if it does go down, I want to cap my max loss. So I'm going to buy a $135 strike put. So here's how this works: is you will sell one put with a $140 strike. And we're gonna say it expires on August 19th. We're gonna say that. We'll just pretend like. And then we're gonna buy one put, 135 strike. That's supposed to be 9. Terrible job. So what you're gonna do in this option strategy is you are doing this at the same time. It's a spread. You're going to sell a put at $140 strike and you're going to buy one at $135. Now, let's break down what we are doing. Most of you probably remember I did a video on cash secured puts. If I ignored this buy one and I said I'm only looking at the sell, basically with this one alone, I would be agreeing to buy shares of Apple from somebody else for $140. So that means if Apple went down to $100, guess what? I have to buy them at 140. Doesn't matter if it went down to $100. I have to eat that loss. So, but you have this other put here that kind of cancels that out. So here's what you're doing when you're doing this. And let's say, now when you sell it, remember, you're going to get some premium, but you're going to have to pay some to buy the option. That net, since it's a credit spread, because this strike, the one that you sold is higher than the one that you bought, you're going to get some premium. We'll say the premium is, I don't know, $50. And here's a reminder. No matter what, the $50 is yours. You get to keep that. It's yours to keep. Now, whether or not you're profitable or not, well, let's break it down. So we're going to look at, this is going to be, the y-axis is going to be the profit, and this is going to be I'm just going to do SP for share price. And the way this is going to work is here, and then eventually it's going to drop off and go down here. And it's going to do this. So this is max profit. Max profit. Hard to write on the side. That's going to be 50 bucks. Now, at what point would you start to reduce your profit? Well, at that point, it will be at the 140 strike. Because at that point, as price starts dropping, you will start to lose money on the trade. Remember, you have a cushion because you got $50 to take it. So you will have a cushion, but eventually your break even here will be 139.50. And that's because, remember, these options represent 100 shares of stock. So 50 cents, if it's 50 cents below it, 50 cents times 100 shares, 50 bucks. You get that math. So if the price on August 19th closed at 139.50, guess what? You wouldn't have made any money on the trade. But it goes down from there, because what happens is then it goes down towards the max loss. So at this point where you're at 135, you're at your max loss. What's the max loss? This is max loss. That's max loss. Your max loss is going to be $500. How do I get that? Because that's the difference. $5 a share times 100 shares. So you could lose $500 on the trade, but you also got $50, for a premium. So your max loss is technically $450. So let's change this, because that is not completely accurate. $450. Now, you're like, well, that sucks. Why would I risk $450 or $500 to get 50? Well, here's the thing. Apple has to go all the way down to 140. What's the chances of that happening? Right? So you can use options profit calculator, options strat. There's some website, and you can look at the probability of profit. If the probability of profit is like 85%, well, then the odds are in your favor, probability-wise. Now, does that mean you still could lose money? Yes, because it's not 100% guaranteed. Nothing's guaranteed. But if there's a high probability that you're going to profit, it may be worthwhile to make that trade. But again, these are great when the stock market is more volatile, because you will collect more premium for it. A stock like, if you do this on like a Coke or an AT&T, you're probably not going to get much money for the premium. And that's what you want, is you want that premium, because that's going to determine your max profit. So again, it's another tool to learn about. And if you want, and like I said, I'm just giving you kind of an overview of what they are so that you can use it and learn more about it. And like I said, I recommend the book Credit Spreads for Beginners. It's a fabulous book. Kind of goes through the mechanics of it and puts a little bit more in the way of words behind it. So if you have any questions, be sure to let me know, or you can drop comments on YouTube, or follow me on Instagram at MDEEPE. That's MDEEP CPA, all one word.